Good morning, everyone. I'm going to give it a couple of seconds while everyone comes in. Good morning to you. Excuse us for being a little bit behind schedule, but I think we're still doing okay. How are you, Lori? Good morning.
Well, Lauren, first of all, we got to see how many are back from the 4th of July holiday. I think some people have taken extended holidays. I know I wanted to. I just wanted to keep going. Tuesday hit me really hard. I was like, oh, yeah, there's that work thing. Yeah, that work thing. What was that again?
100%. I definitely love just waking up when I wanted to wake up and kind of hanging out in my jammies. So
yeah, I know. It seems like for some reason it felt like there hadn't been a time off for a long time. I felt like I just, maybe it just has to do with the complexity of a full life. But I always say I'd rather have lived a full life than no life at all. So every time I get so overwhelmed and I'm about to get stressed out, I go, yep, I'm living a full life. And that's what would make it better, and make things okay. So how was your 4th, Lauren?
It was good. It was good. We went to an event in Long Beach called Big Bang on the Bay, so the day before, and the fireworks show was really, really cool. And they had yummy barbecue, so we were excited.
Barbecue, you can't get better than that. Absolutely.
Right. How was yours?
It was good. It was kind of quiet, and I went for a hike with Babu in the backpack, which everybody knows I take my cat in the backpack all the time. It's been raining, and so when I take her in the stroller, I have a rain jacket that goes over her stroller. And so yesterday I was rolling her along. It starts to downpour. I put my rain jacket on me, the rain jacket on the stroller, and she is so used to being just pushed along in the rain. It's hilarious. I remember the very first time when she's a baby and we went out in the rain, I was like, it's gonna be fun, baby, really. And now she's just like, just put the rain jacket on me, Mom, I'm good. I mean, it's just hilarious all the places that she'll go.
That is so funny. And one of these days you have to have her on the show.
I do. In fact, what I'm gonna have to do is I'll have a picture of her in the backpack and then one on the bike and one on the stroller, so everybody knows I'm not making this up.
There you go.
But before we get started, I'm going to give a quick statement about something that's going to be really exciting coming up. So this is in the future in August. We had a frequent flyer reach out like we often do, and she needed assistance to review her numbers and look at her Excel documents, etc. Right? And so I've been working with her, and she's been astonished what she's learned, and she has promised to come on the show and talk about the experience, the process, what she learned, etc. So that's going to be coming up in August. I'm not going to say her name. I know she's probably listening right now and she's going, yes, I did. I said I'd do it. But I'm really excited about that. And I saw Emma. I haven't seen Emma. I know she's been out on vacation. Welcome back, Emma. Well, I guess we need to throw it to you, Lauren, to get this show going.
Let's get it going then. Give me a couple of seconds. I'm going to share my screen. There we go. All right, Lori, can you see my screen okay?
Sure can.
Awesome. Here we go. Good morning, everyone. My name is Lauren Simpson, and I'm with the SBDC, or the Small Business Development Center. We're a national program with over 1,000 locations across the country, and we offer no-cost services to local small businesses. And they're at no cost to you because your tax dollars have already taken care of our fees. So be sure to get in contact with one of our centers so that we can help you out. For the Los Angeles network, which is the network that I represent, we have locations in the Los Angeles, Santa Barbara, and Ventura counties. And you can see those represented on the map in front of you. You'll see we're as far out as Santa Clarita, over to Pasadena, Los Angeles, as well as down in Long Beach. So if you're in any of those areas, please contact one of our offices. And you'll want to do so because, again, we offer no-cost business advising. And so you're able to meet one-on-one with one of our business experts. You can be lucky enough to sit with Miss Lori Williams, who's the guru of all numbers, all calculations, as well as experts in the fields of gaining access to capital. You'll meet someone special very soon, as well as business plans, marketing, you name it, we've got it. And then we also offer virtual trainings, much like the training you've joined today. So as you can see, we are here to help. please contact us via phone 866-588-7232 or online smallbizla.org/new client. If you've joined us outside of our network, then you can go to americassbdc.org/find your SBDC. With that, I'm going to stop my screen share, Lori. Quick housekeeping. Please be sure to put all questions into the Q&A. Again, we'd love for you guys to interact with our speaker as well as with Lori today, but put those questions into the Q&A. The chat will be reserved for any information, any links that Lori would like to share with you. With that, Lori, it's all yours.
Excellent. And also, Lauren, can you put in the chat when you get a second the link to sign up for the show? I wanted to remind everybody you don't have to be an SBDC client to sign up for the show. I had somebody the other day that said, can I send this to a friend to watch? Absolutely. So please, if everybody on the show has somebody that they think might be interested, please send out the link. Let's get our audience growing. It keeps growing and growing, and I'd love it. So can we have a, bring a friend summer? If you could bring a friend to the show for the summer, that would be great. So I want to get through some of these slides real quick because we have an excellent guest and I want to allow enough time to speak to them. So one quick update regarding California tax law of PPP loans. Fully conforming California law to the extended federal paycheck protection program, the PPP, which prevents these federal grants from being subject to state taxation. Okay, that's the language, guys. Now let me translate it. So what happened is the federal IRS law regarding PPP loans was a situation where it was not taxable income. California also abided by this, but then there was an extended time period that it was not abided by, and they just changed that. So basically it says that your PPP loans will not be taxable as income. So I just wanted to give a heads up on that. These are my upcoming classes, the finance classes. I'm getting a lot of good response from. People are really walking away having a better understanding of their finance. My sales tax coming up, reminding everybody, if you even wonder if you should be charging sales tax, tune into this webinar, because a lot of people, especially those that are using Shopify that does not collect and submit the sales tax on the behalf of the user, are doing it incorrectly, and you don't want to get into any kind of trouble with that. I also wanted to bring up my colleague Andrew Cohen is having a webinar on July 22nd where it's a business plan process. And I brought this up because last week, or I think it was the week before, I lose track now, Sylvia was talking about use of her business plan, and a lot of people were asking questions about a business plan. So I'm now bringing up this webinar as a really good resource. And then upcoming, we're going to have in the next week a special Ask Lori, digging deep into helping you to fully understand the gross profit margins. I talk about it a lot. I talk about the need to understand the financial health of the company. I'm going to do some more begin with a blank Excel document discussions and demonstration. Really, I'm going to demonstrate you some aspects that really explain my statement that you don't want to be more tired and more broke. I'm going to go into more tired and more broke so you understand what that means, okay? And on July 20th, Andrew Cohen, who is also going to be the person that's presenting the business plan, he's going to be on as a guest. He also is the CEO of Work Better Now. He's going to tell you about the company, starting the company, etc. So that's the upcoming shows. But today, we have a very exciting day, as always. Let me just do some real quick arranging of the screens here. Our guest today, Nate Jemison, is an experienced business banker with over 20 years experience in commercial and corporate lending. Nate also has over 20 years experience providing independent financial consulting services to small and medium-sized businesses. Nate's a graduate of the California State University, Long Beach, and has worked for Security Pacific National Bank, Union Bank, and Manufacturers Bank after graduating from the formal Security Pacific Bank Commercial Loan Training Program in 1982. He has owned a financial consulting business since 2001. Nate has been an advisor to the SBDC since 2008. He is currently the manager of the LA SBDC Access to Capital team, known as the ACT team. Now, one thing I like about Nate is we have somebody that's got the old dates like I have, so he's old like I am. I love that I said that. And the other thing is, having been a banker previously, I remember some of the Security Pacific National Bank, et cetera. But what I wanted to express from his bio that I spoke of so far is Nate knows lending. He's been in the banking industry. He's been around for a long time. Now, why I wanted to bring Nate on the show is with the PPP, the EIDL, and the other government programs basically discontinued. I keep getting a lot of questions about available funding, including loans and grants. We've been getting a lot of questions from clients. The SBDC's been getting a lot of questions regarding this. So what I wanted is Nate to come on the show and kind of provide us with an update on the lending options for small companies. So with no further ado, let's welcome Nate to the show.
Hello.
Hello. Thank you so much. We have talked about you coming on the show for some time. I'm so excited to have you here. Now, Nate, a lot of people do not know what I'm talking about when I say the Access to Capital team, the ACT team at the SBDC. Can you tell us what services does this team offer? What does your group do?
Well, the Access to Capital team was created, in 2018, but around that time, primarily strictly to focus on helping small businesses gain access to capital. Previously, we had all of our team consisted of ex-bankers, people in the lending community. So we wanted to provide this valuable experience that we have that can help our clients at the SBDC obtain funding in a focused fashion. So in other words, we would take in a client who's interested in gaining access to capital or loans for their business or even equity, and have them prepare certain packages and things like that to get them ready to meet with lenders. And we have a group of lenders that we work with that we know they're basically their sweet spots. In other words, what they like, what type of lending they like to do. So we can refer the clients more directly to those lenders. And also.
So the key is here, guys, as you're hearing Nate speak, it's access to capital. And so you're helping them prepare to meet to a banker or lender, whoever may help them with the funding, and also getting them not only prepared, but knowing the best introduction. You know, it's a banking term and we talk sweet spots and we talk appetite, Nate, but when we say appetite to this group, they think, what are we having for lunch, right? So what I always try to explain to people is that due to the different regulations, which I'm going to let you explain it in your words as well, all banks are not interested in all types of loans. Some are only real estate, some are maybe crops, some are this, some of them change their focus. So you might knock on a bunch of bank doors, so to speak, or lending choice doors, only to find out it's not a match because that's not the kind of loan. So a lot of times people don't realize that there is a specific loan that bank may be looking for and a specific one they may look for now. Want to elaborate on that a little bit so people understand that benefit of getting that match?
Absolutely. I guess I could use the garment industry as an example. There are some lenders that prefer that are closely located within the garment area. That doesn't necessarily mean all of them are going to be doing garment lending, but there are some. There are some lenders that prefer commercial real estate. There are some lenders that prefer, depending upon the ask, your need, they would prefer to place you like in an SBA product because they don't like doing loans above or below a certain limit. So there are also loan limits that some banks have to observe. So depending upon what your need is, you want to be clear on that to help determine where you might go to lend. Like there are certain banks that have a good reputation. For example, I'm going to just throw a bank name out here. U.S. Bank has a good reputation for doing small business loans, but they mostly park them in the SBA products. But they're pretty friendly to some individuals who want to get startup funding and things like that. Some banks don't do startup funding at all. So you need to have an understanding of what that bank might have to offer you as a small business person. So I always tell people when you're thinking about getting a business loan, you always should go to your bank first.
Yeah.
Let's have the opportunity to see if they can help you. Because if you have to go to another lender, it's more likely than not, they're going to ask you to transfer all your banking relationship to them. So you want to give.
I'm so glad you mentioned that, Nate, because people don't understand that. And so when they say transfer the banking relationship, what they're saying, guys, is your checking account, maybe your personal account, probably your personal account. We say maybe, but it's probably all those accounts are going to have to transfer to this new bank. And you know how hard it is setting up a new bank account. If you've got a bunch of things attached, you've got QuickBooks attached, etc. So you really have to understand that they want the whole relationship because it reduces the risk. And so that brings another aspect that I like to communicate on, Nate, and that is I try to get people to almost flip the way they look at it and look at it from the bank's perspective, and to realize that as much as the banks want to lend money, they have regulations, they have credit limits, they have rules like you have to be in business a certain amount of years for traditional loans. So you have to understand that there are certain criteria that banks have in place. And although they like to say we lend on the relationship, it's not just like, oh, I like you, I trust you, we had a good lunch, I'm so excited about that idea. That idea is great. That's actually just fluff. In the end, it comes down to numbers. That's my statements, Nate. You take it from there on what you're going to say on it.
Absolutely. Basically, you have to make sure that you're ready to borrow, and you have to make sure that you have all the required documentation that a bank is going to want to review as part of the decision-making process. Yes, some banks are limited as to how much of a portfolio they can take. For example, if a bank is doing commercial real estate loans, for example, they have regular limitations on how much that portfolio could be in total. Like it might be billions of dollars. If they're reaching those max, things like that, they might not be able to do any more of those commercial real estate loans. If they're lending to a specific industry sector, like hospitality, which really kind of suffered during the pandemic, the tolerance for doing restaurant loans might be very limited, or it might require a lot more documentation, especially like when it comes to if you've had SBA EIDL loans and those kind of things recently on your books. Those will need to be reviewed. That information needs to be upfront and forthcoming when you talk to a lender. But yes.
Yeah, you know, I remember when I was only a banker for a short period of time, I did it to have the experience, which was just great in my career being a CFO. I just wanted the experience. But it seemed like they would say, go get real estate loans. And I'd run down. And by the time I got to the bank with the real estate loans, no, we don't want any more of those. Get this. And you know, people don't understand that aspect of it. But you touched on something, Nate, and I'm just going to use you as a tool to speak what I speak here. You ready for this, Nate? So we talk about documentation, and I am always, Lauren can contest, I'm saying you must make sure your financials are correct. Don't just take QuickBooks, do the online, do the switch and go, oh, my data syncs miraculously, it's perfect. I tell people that they ignore the correctness of their documents until that day comes when they want to give Nate a call and Nate pulls up the balance sheet or ask Lori to pull up the balance sheet and we find out it's a mess. So can we begin with the end in mind about how important these financials are within a company? Because I tell people all the time, they spend all the time on, look at my cool little Instagram shot, and they think finance is something they should spend this time to no time, or it's a pain in the butt, and it's a leg of the stool. And so that's my soapbox speech. Can I have you take your soapbox speech on that, Nate?
Absolutely. Documentation, especially like relative to your tax returns, your internal financials, is very critical. It's kind of like a reflection on how you're managing your business. I know a lot of small business owners do not really keep internal records until they see their tax guy at the end of the year. When you have a banking relationship, that's not really good. So like Lori was saying, you really need to have internal financial reporting tools because you want to know where you are. How, if you want to come in to get a bank loan at August, say, and you haven't even prepared any financial reports during the whole year. We're in 2022 right now. It's June or July, and we would want to see as a lender that you have at least prepared an internal quarterly financial statement, maybe something for March or June. We will ask you for your tax returns. If you haven't done your 2021 tax return and it's on extension, you definitely have to have your 2020 done and an internal financial report, at least for the 2021 year. So financial reporting is very important because that's one of the 5 C's that's included in a bank financial analysis, which has to do with capacity. They want to know how they're going to get repaid. That's the bottom line. And the only way they can make that analysis and that determination is to have current financial data. So that's
And
very
and one of the things that I tell people is it doesn't have to come from an accounting software. It can be an Excel document. It's not what generated, it's that they're accurate and it follows the appropriate layout presentation as deemed by a financial accounting. And a lot of times I tell people, you're better off with an Excel than a messed up QuickBooks file, by all means, because a lot of times, guys, I'm on the ACT team also, but I don't work in Nate's capacity at all. I joined his wonderful team some years ago to be a support. I'm the one that goes through the numbers, gets the QuickBooks files back in order. And often I'm creating an Excel document to give back to them, guys, so they can present it to the bank, because I can't even fix the QuickBooks in such short period of time. So I get the numbers correct. I go back to the original data, tax returns, give him an Excel document. So I didn't want anybody to walk away thinking you have to have an accounting system. I'm often happier to see just an Excel document because at least I can see the actual numbers and know that it's correct. So Nate, here's another.
Can I add one thing relative to that topic? Because it's very, very critical. Time is money. Okay, so the lenders like to keep that in mind. They like to keep those things kind of moving. So if they've got to sit there and try to figure out what this financial statement is telling me, they're going to tell you no. It just leads you to a quick no. So you want to have good financial reporting tools at your disposal when you come into a bank and ask them for a loan, because again, they're not going to want to spend the time to try to figure out your financial statements if it's disorganized and things like that. And it's a reflection on you. They're going to think that this guy, he needs to get some help. We can't really do anything for them because their financial reporting is a wreck. And so you want to make sure that's accurate. So you should see people like Lori, see the ACT team or whoever before you apply for a loan and you've got financial reporting.
You know, Nate, that is crucial. I'm going to actually come back to it on another level. You know, you spoke of the 5 C's, and I remember when I went through my little bank training, have to understand the 5 C's. And the one that, and I might be misrepresenting this in its completeness, you'll tell me, but the one with character, I always explain, it used to be shaking hands in the olden days, but today it's the integrity of the numbers. And if you look at somebody's balance sheet, you see some weird number, it immediately creates this character issue, which translates to, if that number's not correct, how can I believe any of the numbers? And that brings the whole banking relationship to a halt. It causes them to audit every single number, and it may keep you from even getting a loan. So when I do the financials, I have to make sure they perfectly match up with the tax returns, and everything makes sense financially, follows the financial rules, because all they got to do is they're auditing to find one little thing that doesn't make sense. And the minute that one little thing doesn't make sense, they think there's something underneath that goes deep. You want to comment on that?
Yeah, absolutely. If you're reporting, if your accounts aren't correct, and if you're, for example, it doesn't match your debt, like what happens a lot of times, this is one example. People ask for money, a loan that they want to, for working capital purposes. And a lot of times, sometimes this kind of gets into the asset-based lending part. Those loans are supported by accounts receivable. So if you're not reporting your accounts receivable, your balance sheet might be upside down. You might have a debt on the books that's not supported by the assets. So you want to make sure that when you're borrowing money, you want to be specific as to what the need is, what that money is going to be used for, because it really matches some assets that might appear on your books. And this is kind of getting kind of deep, I guess a little deep, but a lender is going to be looking, and if you don't have asset match, or if it's not, can't be trapped to your operating expense, your P&L, you might be upside down on your debt to worth. So that's a very important factor that a lot of lenders look at. So you might have so much in liabilities and so little in assets, so you have a negative net worth, and that's an automatic decline.
Now, guys, what Nate said right now in those sentences, and we're going to unpack it a little bit, because what Nate said is so important, and most people don't have this experience and all this terminology. So I love what you just said, Nate. We're going to unpack it little by little by little. So first of all, when Nate is talking about your debt to equity and all these ratios, it's your balance sheet, guys. And so when you look at your balance sheet, your assets are going to be what's in the bank account, accounts receivables, clients owing you money, right? And a lot of times people aren't cleaning up these accounts. I see people syncing their data online, and I see negative bank accounts, and they go, oh no, my bank account's not really negative. Well, of course it questions the numbers. Now, when you look at your accounts receivables, people aren't cleaning that up either. They maybe aren't writing off old debts. So account receivables look negative or something strange. And so it's a matter of knowing that these assets are really true by looking at these balance sheets. So that's where it becomes real important that people put the balance sheet categories correct. And when I look at people's internal reporting, especially when they're just syncing the data with QuickBooks Online, which I'm not a fan of, I don't do, you'll see that they're off completely, and they're just not realizing it and saying, well, then my P&L's correct. No, these are all connected. So if this is incorrect, this is correct, but they don't ever look at the balance sheet. So I first wanted to explain how this is tied in the balance sheet. Now, Nate, I want to unpack something right now and go to this direction of asset-based lending that you said. A lot of people don't know what that is and don't know that as a tool. So I'm going to first just give a little bit of definition, then I'm going to let you take it. And that is, when we talk about asset-based lending, if I say to you, you're going to take out a bank loan and you're going to use your house as equity. Everybody knows that. They're like, I don't have a house. I don't want to use the house. They know that. They understand when I say, put up your house, don't pay loan, lose your house. That's about as plain English as I can get, right? House, bye-bye, not good, right? Well, say you don't have a house. Well, a house is used as collateral, you know that word, and it allows them to say, you don't pay, I take this. Well, there's other things that businesses have that can be used on this concept. You don't pay, I take this. And they're assets. And an asset could be an accounts receivable, money clients owe you. They say, okay, we know you're going to get paid. This is a big name, so we know you're going to get paid. We'll attach to that. Or it could be inventory if it's not a finished good, like if it's the wood for a chair versus the chair. I can take the wood and resell it, right? So the asset-based lending, oh, and a PO. I get a PO from Costco. I can verify it. There's PO financing. So asset-based lending can be accounts receivables. It can be PO financing. It can be based on inventory. These are beautiful aspects and opportunities for small startups, because suddenly maybe you get a PO from Costco and you can use this. So this is what Nate is speaking of when he talks about asset-based lending. And Nate, I don't know this, but probably a good majority of small companies are using asset-based lending versus the traditional loans or not. Take up on that and tell us from our viewers, what do they need to know about these options? Because I bet you a lot of people on this show today don't even know what I was just presenting.
Okay. The primary way to finance a growing company is through asset-based lending. But normally, more asset-based lending options would be available to a company that's kind of been around and established. That way, a lender will look at your historical accounts receivable aging reports, your inventory reports, and some of these things you might not have or prepare regularly. So a true asset-based lending line of credit might not be available for you. But let's talk about who it might be available for. Say you've got a multi-million-dollar annual sales company, you carry receivables of $1 million on average per month. You carry maybe some inventory of $250,000 per month. Those assets can be used to get 80% of your receivables base, whatever that average is, in financing per month. So for $1 million company, you could probably borrow up to $800,000 against your receivables, and you might be able to get say 10 to 25, or maybe even 50% from some lenders to borrow against your inventory. So if you've got a $500,000 in inventory and you get a 50% advance rate against that inventory on average, that could give you a line of credit of $250 for the inventory part plus $800,000 for your receivables. So you can have like a line of credit of $1,050,000. And you can advance that money. However, normally it requires you to pay a line of credit like that at least 1 year. They might do the line of credit for 2 years. So as you collect your receivables, normally the lender might require that you submit the payments to them right away. They'll distribute whatever's left over as far as your profit margin to you directly. So it can be a controlled account situation as well. But asset base is going to be based on a pool of assets that the company has. Could be like Lori said, accounts receivable, inventory. For a young company, a growing company, like Lori said, if you've got this large order from, say, a Macy's or from a Walmart or someone like that, you can do an asset-based loan from a PO financer or a factor. They're normally the first ones who step in to support a small business that's growing rapidly, that has a lot of good customers who are kind of like good large retailers, well-known, because they're going to rely more on the retailer's credit history to pay you. And in some cases, some lenders might do some government contract financing. That's kind of rare because government normally kind of prevents you from taking control of receivables, will prevent the lender from taking that control of the funds, in other words. So they'd rather give the money directly to the customer themselves. Whereas a lot of times in factoring and in AR financing, the lender wants to take control of that asset. In other words, they want to make sure they have a security interest in it, and that the customer sends the invoice payment to them, and let the lender distribute the profits that's owed to the customer directly to them that way. So it's like a controlled situation. So you just want to kind of be aware of that. But again, it kind of goes down to your internal financial reporting, how solid that information is to determine whether you're going to be qualified for an asset-based loan. Whereas a PO asset-based lending line of credit or loan is more just based on your customer, your business customer, that retailer or whatever's credit history. So it's a little bit easier, especially for a fast-growing a company that's growing rapidly. Because one thing, just so I'll finish real quick. One thing a lot of lenders want to try to avoid in asset-based lending, if 2 or 3% of your customers are providing you like 80% of your business. In other words, you got two very large clients, say Macy's and Walmart, and they represent 80% of your annual sales. A lot of lenders are risk averse. They don't really want to get involved in that. You have a more diversified base of customers. In other words, your receivables are from 20 different customers as opposed to just 2, representing 80% of your revenue. So that's something you want to be aware of as well.
You know, that's another fascinating point. And guys, you know, when we're talking about PO financing, like you said, Nate, that's the one I see that the smaller companies be able to first enter into. And you guys that are frequent flyers on the show, you remember Leanna from Took Take just maybe 4 or 5 shows ago, where she was suddenly getting all of these orders from Walmart and she had to buy inventory. She's looking at that kind of solution going forward. It's a perfect example because we learned from her. Now, Nate, another wonderful thing you mentioned is about all the money from 1 or 2 customers. That's called concentration of receivables. And if you are never, ever, ever going for a bank loan still, that's a very good thing to know within your company. When I do a financial analysis for internal management, that's internal decision making, I have them run their total sales and identify how many customers that comes from, because that shows vulnerability within the company. Yes, a bank is seeing this vulnerability, but I wanted to take an opportunity to say that's one of the reports I do internally in all companies when I look at them, because you kind of know, but you really need to run these numbers constantly and know what is the percentage of your highest customer. And I always say either get some more customers or really kiss their butt, you know. Your choices with decision management. I told you guys, we got to do some real kissing of butts here, because we got an 80% concentration of receiving. I would always say that. This is awesome. So Nate, we're going to unpack another thing, okay? So when people think about it. And I didn't know any of this until I became a banker. I became a banker late in life as I was expanding my CFO knowledge. So I was kind of like, ooh, look at this. I didn't know this. So I speak of it still with that excitement of realizing that you didn't know, because I didn't start out as a banker and I didn't start in finance when I was young. I was the marketing fuzzy person at 25 when I started my company, Nate. I know I'm the guru of all numbers. You'd think I was a long-term finance person. I wasn't. That's why I think I know to bring these topics up, because I know what it's like to have not known, right? So when people think about SBA, first of all, they either think that there's like a government institution that's a little SBA and you walk into this government institution over here, right? They don't quite get it. And when I explain to people that an SBA loan is technically a traditional loan with the cosigner of the government, so the bank can let go of some of its strictness and lend to it, because it says, okay, I normally ask for this and the bank tells me I got to, by regulation, not lend to anybody that's this, but the government's signing off on a good portion of this loan, so I can lessen some of my banking criteria. So it's really about going to a bank and getting a loan that's got the SBA as a guarantor, but it takes a lot more documentation. So let's just talk about traditional versus SBA loans just for a second, because that is a resource that a lot of small companies use.
Okay, let's just make a clean, simple example.
Okay.
Say you have a small business, you've been in business for 3 years, and you're looking just to buy let's see here, a forklift truck, a good hard, piece of equipment, easy to, doesn't change much. It's a forklift, they have good like resale value and things like that. So you need about $100,000 to buy that truck. Well, normally when you go to a bank for a traditional bank loan, they say, okay, he's been in business, he's profitable. Okay, so you cross those barriers or leap over those barriers. $100,000, they're going to probably want you to put 10% or 20% down on the cost of that truck, right? So some lenders might want you to put 25% down, but that's a good piece of equipment. It doesn't really change much, so it holds its value pretty well. So let's just say they want you to put 20% down. You don't have 20% down. And let's say also your credit, your individual credit might be a little bit below their parameters. They want everybody to, who's applying for a business loan, they're going to want you probably to guarantee the business loan personally. So they look at your individual credit and they see that maybe your credit score is 680 and they want only 700s. Banks have these kind of criteria, they do. So they say, well, he's too weak as far as his credit score to get our traditional loan. Also, he doesn't have the 20% to put down to buy the truck. He's ideal for a SBA guaranteed loan. We can do this loan under the SBA guarantee because he doesn't meet our credit criteria and he doesn't meet our owner's equity injection of 20%. Because the SBA can do a loan with 10% down, 5% down. They're more flexible with the guarantee. Now, that doesn't mean the bank doesn't make the loan, because they actually do make the loan, but the loan is guaranteed by the SBA with a guarantee of 80% and 95% in some cases, depending upon the SBA program they choose. So the SBA is a credit enhancement for the bank to make that loan to you because of some deficiency you might have that might not allow them to make the loan to you under their traditional business loan products. So all banks have a traditional business loan that they do for, like, if you were, say, somebody very popular, like Taylor Swift, you walked in and you wanted to start a hair salon business, the banks would probably crawl all over her for a traditional loan, right? Because she makes a lot of money. They know that. And although she might not have the experience, she knows who to hire to run the business. So her business plan might be pretty solid. We know she's got the financial backing. So they're not even going to think about giving her SBA loan. But if Nate came in there and he wanted to open a salon, I don't have a whole lot of experience, so I might be kind of weak in that criteria. They might do a SBA guarantee loan for me. So it really just depends. But the bank actually makes the loan. The SBA just guarantees or creates an enhancement for you to make the loan to that small business owner. That's separation.
Okay, Nate, now we're going to do a little change of thought. We're going to do what I call the myth busters. I do these all the time where I come out and go, well, guys, that's not true. Some people call me the dream ruiner, but I'm the biggest face of reality you will ever meet. I'm black and white reality to the core. So I'm going to do the dream busters, okay? And I'm going to throw them your way. So this is what I'm getting a lot of calls. Tell me about the latest grant that I can apply for. Where can I get a grant? Or I want to start a company and get a grant. Well, I need to, my company's not doing well, so I want to get a grant. Grant. And people never said the word grant like they have since the last 2 years. So I keep saying, that was not the way it's going to be going forward. That was situational, but they got it in their head that grants are a plethora of options to run a company and start a company. What do you think, Nate?
Okay. First, I just want to say banks do not provide grants. Okay. I just want to be clear on that. All right. Now, there are some what they call like certified development financial institutions that might provide grants from certain things at certain points, but grants generally are not the way. Definitely not traditional ways to fund a business. They're not. Grants are really intended and were created for nonprofit organizations. That's what really grants were first started for supporting. So they can raise grant funds through various foundations, private foundations. Sometimes government will park money in a certain fund that allows for grants, like they did for the disaster programs. They had idle targeted advance and things like that. And grants are normally very limited in the amount that you can get, unless it's from, like I said, a private foundation that's funding a serious organization, like the AIDS Healthcare Foundation. They've been funded by grants. That's really all they kind of get, but they're a big organization. Small business operators, you might find a grant from time to time from a private individual who has a fund that is willing to support, say, a daycare center somewhere, but those things are very rare and they're very limited, and you're competing with other people to get access to that money. So the one thing I just want people to know, you have to be ready to apply for funding through some other source, because grant programs are, especially related to this COVID-19, what have been available for a lot of people, are going to be ending. The money's going to run out. Plus, it's very competitive to get those funds, and they're normally very limited. Once you get the seed money from a grant, you've got to start thinking about exploring other traditional or SBA or other government-supported funding options to really grow your business. A grant's not going to be there to grow your business. So,
thank you, Nate.
Be clear on that. Grants are not out there to really help you sustain your business. They might help you through some crises or something like that, through a little bit of funding, but they're not really going to be available to sustain your business.
Okay, here comes myth number 2, and this is the biggest one for me. This has been before COVID. Okay, you ready? I hear it so much. I'm going to start this company. I got this great idea, and I'm going to get equity investors, right? And I tell people that, and this is an old statistic, but I'm sure it's probably about correct. I did a lot of teaching within the universities, and I would say, I'm about to tell you the best funding that is used, maybe not the best, but the most, by 97% of the companies that start, they use credit cards. And how many get equity investors? About 0.1. Hollywood has taken over entrepreneurship, and it's given this false belief that there's all these investors that are going to flood to your company. I've worked with investment banks doing financials for years, and they say, you got to have a known product, et cetera. That part is lost. That understanding, Nate, is completely lost within the small business arena, and it's propagated by Hollywood and fictitious beliefs and some of the colleges that kind of feed into that. Can you correct people's understanding or give whatever you want to say to people who are betting on having an investor?
Well, for most small businesses, an investor, a lot of times an investor is probably somebody a friend who's got a lot of money and believes in your concept. But the equity market is a total different ball game. I mean, most equity plays are opportunities to get in at an early stage and gain a fast reward within a set period of time, like maybe a few years, with the intention of going like public, or at least, if not public, because remain private, but to really have a product that captures the interest with a fast growth trend. Equity is not normally a way to fund a general businesses that we mostly think of. It's mostly like right now, the tech sector has always grown. People continue to create certain products and things like that that might have some real strong equity play later. But during that development stage, that's when the equity investors normally would get involved based on a lot of hard information that they have you prepare for when you are ready to really launch your product. So if you're like have a beauty shop or beauty salon or something like that you're thinking about, you're going to get equity. Yeah, you could probably get equity from your friends, some expensive, some relatives or people like that. But that's not really going to be like an equity play industry where there's fast growth opportunity. Again, it's mostly in research, products. You got to have a product that's really going to be something that's going to take off and have a big return for equity play or a public sale at some point for everybody, all the early equity investors to get their rewards. So
thank you for that, Nate. Thank you for clearing up, because a lot of people just don't understand. I mean, I worked a lot with angel investors and stuff at the time back in the day, and they say they have to have a proven product, proven sold, proven management, and later is the key. And you know what I always used to say? Your first money comes from friends, family, and fools.
I won't say anything about the fools part, but it's not unusual for like your friends, family, and you had mentioned credit cards too.
Yeah.
Ooh, I kind of discourage people from.
I know, but it's the truth. It's how it's done. I agree with you, Nate. I hate it. I don't like it, but it's the true reality. It's how they're doing it.
Yeah, it's true. It's very true, and it's sad because it's kind of like a double-edged sword. You run up your credit cards and everything to run your business, sustain your business. I just think it's better just to plan first. Really plan your business strategy first before you start engaging and just starting. Like a lot of times, people will just form a corporation and it'll be dormant for 2 years because they're still not really ready or can't really qualify to get the financing to take it off to start the business. So just be aware. Don't start using your credit cards and everything. I'm going to get in this business regardless of how much capital I have. I'll just use my credit cards. That could really work against you, because when you start having some success and you're ready to go to a lender, they're going to look at your individual credit and see that you're kind of overextended, and and a lot of times they don't have anywhere else to go but to the bank.
Yeah. And that's why I'm always preaching about doing financial analysis, showing your profit margin. I create these Excel models, where we're going to be discussing again next week, is you don't have to get in a position where your credit card's racked up and you're not succeeding. If you put it down in an Excel and do scenario planning, which I do, and models, it'll tell you before you throw away the money what's going to happen, or at least what you must do. What is the price you must sell it at? What is the cost of goods? What is the overhead you can do? All of those things. Nate, another area that is available, and I'm just going to kind of keep it open, and this isn't an area that I know a lot about. This is where you're an expert on it and I'm not. But there is a whole group, and I'm just going to call it micro lenders. They could be some of the government ones. I'm going to call you take it from there, because there's a lot of resources, especially the ACT team has a huge relationships with micro lenders. Talk about what they are and what part they play in the lending process.
Most micro lenders have limitations as to how much they might be able to give you, although some have increased their limits to like up to $100,000. Normally the process is a little more simplified, but one of the key things that you need to have is make sure you have accurate financial data. So that kind of goes back to what we were talking about earlier. But they're there, they serve a purpose, and normally they are normally take a little more risk, whereas most traditional type loans of 50 or 25 or even 5, microlenders could probably lend as much as $1,000. But that's normally not going to be available at a traditional bank. Okay. Normally a microlender would be a certified development financial institution, which is private type of could be private or public type entity. But they are there for the specific purpose of providing microloans through the SBA, because SBA has a microloan program, but they normally have a CDFI process the application for that. But again, normally a micro lender. They're located throughout the country. You can talk to a local church. Some churches might do micro loans. There are other organizations that do micro loans as well. So micro lending is a very, very popular product, especially for people looking to start a business, because micro loans can be used to start a business, open up an office space and things like that. But normally they come in limits of 25 or 50,000. And like I said, a few CDFIs, private lending institutions, they do micro loans up to $100,000.
I think this is where the ACT team is very valuable. Everything they do is valuable, but since I've been experienced with the SBDC ACT team, I've become aware of micro lenders that I didn't know exist. So in other words, these aren't the kind that you drive by and you see a big billboard that says, come in here. They're not trying to hide, but they're not as well known in the community, in the business arenas as other banks are. And so a lot of times there may be options. And that's one of the advantage, guys, is you're learning. There's this, what we call credit appetite, that isn't, I'm hungry for spaghetti right now. It's what the bank's lending and what the banks can lend. There's getting the financials correct. There's the character, making sure that your financial and the integrity of the data is correct. So you can see there's all of these aspects that goes in before you even determine who to speak to, yet alone speak to. And that's where the ACT team is kind of bringing in options, bringing in the ability to make sure the financials are correct, et cetera. And there's a great advantage in that. So I think micro funding is a interesting option that I know when I was the CFO of companies, although they were bigger, so we could use some of the asset-based lending and stuff, I didn't even know they exist. So we have a question, and it's a very specific one, and I'll throw it at you, Nate, to see if you can answer in this forum. But what's the best bank to get a loan from for a transportation company? So transportation companies, what you're even answering here is sometimes it has to do with certain companies, and you're laughing. I'm not going to say any more. You just go for it.
Well, it's kind of like this. I think what you want to first think about when you're thinking about financing anything is how much money you need, what you need it for. For example, you just mentioned a transportation company. That sounds like that's something that's pretty simple for a lender to really support, because they're going to think, oh, maybe they need vehicles. Mm-hmm. They need operating expenses. So what they would probably want you to do is have a business plan or be specific as to what you need, because vehicles are an excellent source of collateral. They will take that back if you don't pay, right? Just depends on what type of transportation financing you might have. Now, as far as the best bank, again, that's kind of a general industry that might be, a lot of banks might be open to. Depending upon the need, I mentioned like a couple of banks, US Bank might be good, but ask your bank first. If you have a banking relationship, ask them, let them know about your transportation company. You need to buy 3 trucks. I need to hire 2 more people, etc. And they should probably be able to help you. But you can also ask your banks about any micro lenders too. I mean, most banks have a network of lenders that if they can't do the deal, they can refer you to a micro lender. Or if it's too small for them, they don't do loans less than 50,000. They probably have a list of micro lenders too that they can refer you or have you talk to. I always say, don't apply right away. If somebody refers you to anybody, talk to them first. Let them know what your need is, okay? That's what you want to do before you fill out any application, because the first thing a lot of lenders do when you fill out the application, they order your credit report. And not knowing anything about your project or who the owners are, that's just what they do. And you don't want to start running up credit and having all these inquiries, and you find the right lender and you say, well, you know what, you've got too many inquiries and I can't help you because you surpassed 6 inquiries in a month. So,
that's another thing.
Talk to the lender first.
Yeah, when people shop around, and one of the things you mentioned, Nate, is like when you said the transportation company may be vehicles and that's asset we can get back. I'm going to, state something and have you comment on, I'm going to call it the contrarian on this. And that is when you're wanting to borrow for working capital. So first of all, people don't know exactly what that word means, working capital. And I always say working capital loans are the harder to get loans if you don't have a house. And so can you walk into what I just said and we'll take people through that aspect?
Absolutely. Working capitals basically are your operating expenses. I mean, I need money to pay employees, so that's salaries. Sometimes working capital could be, well, working capital is to buy inventory, products, parts to build the product you're manufacturing. Working capital is just your everyday monthly expenses. How much do you spend on your operating expenses every month? All those could be called operating expenses or working capital primarily. That's the capital you need to run your business. More focused, like financing for receivables, is considered working capital. See, there's working capital and then there's term debt. Okay, so a term debt would be like buying that truck. You need a loan to buy a truck that you're going to pay monthly payments on. But working capital things are things that you burn cash that you burn through every month just to operate your business. And say you're going to grow. You're going to grow your business, say, at the end of 6 months because you're going to add some people, so you need working capital to pay people. You're going to need some working capital because your utilities are going to go up because you're going to have more people. You need some working capital because you're going to be buying more inventory or supplies or things like that to run your business because you're on a growth pattern. For example, like we talked about Walmart earlier. So you got a contract with Walmart to supply more shirts. That's going to be pretty much a working capital loan. You're going to need to buy the materials. You're going to need to buy everything that goes into producing that product and getting it out the door. Even the shipping cost is working capital. So all those things are working capital. Now, cost of goods sold include working capital items. It's going to be, that's where it comes in. You got to buy buttons, you got to buy fabrics and all that stuff. That's working capital. But it gets categorized, and that's where Lori's the expert, differently when you do your financial statements. It's going to be a cost of goods sold that applies immediately to the finished product being sold, whereas everything else, the payroll, to produce that product and everything, that's going to be operating expenses. And that's not really going to vary because the people are going to make that money, the salaries, regardless of how much you produce. Yeah. So that's kind of just, you have to look at all your operating expenses as working capital related expenses. And I think a lot of times people aren't really sure when they come in for lending how much they're going to need. They always kind of guess. Well, I think I might need this. Well, you have a history, if you've been in business, of what your operating expenses are every month. So that kind of gives you an idea. So I always tell people, when you're looking for working capital, based on I need 90 days of working capital. And that's your operating expenses. So if your monthly expenses are $30,000 operating expenses, you want 90 days of that, you're going to ask for a loan of $100,000 or something around there. 30,000 times 3, 100,000. Because most lenders will be comfortable loaning to you, if you're qualified, up to 6 months of operating expense every month, but not the whole year. A lot of times people, a whole year's worth of expenses, that's not going to happen because they're going to think that you should be able to start producing revenue to help you pay your operating expenses. That's the goal. So the thing from 90 days to 6 months is probably being the maximum amount a lender would want to give you for working capital, and that relates to your monthly operating expenses.
Nate, we're actually out of time. First of all, I'm going to ask you to come back sometime. This has been
absolutely
great.
I'm glad to.
I'm going to come back with a final thought, but before we do, I just am going to do a few homework things, and that is, Lauren, can you throw in again the link to the business plan class? It came up, and I think that's a great class for people to get started on their business plan. I know it's in their chat. Can you throw that in again? For those who have a question or want to get in touch with the ACT team, someone like Nate, someone on his team, send an email to Lauren, just like you do to get in touch with me, and she'll send it to me and just put your question or your need in. So that's how you're going to communicate for any of you guys that want to get in touch with the ACT team. Nate, as a final thought, anything you want to let our audience know? And first of all, before you say that, I just want to say thank you. This has been such a great opportunity for people to get exposed to these terms, this knowledge, the options, get the myths blown away. This is what I like, is these discussions that have people really come to a full understanding. So I can't thank you enough. But any last thoughts you'd like to leave with us?
Absolutely. Thank you for inviting me, and thank you to the audience for listening. I just want you to be aware of where we're headed as far as the industry, the lending industry in total, coming out of the COVID-19. A lot of what's happening right now is lenders are looking for opportunities to loan money to small businesses. But one thing I want everyone to kind of take away from this is, if you receive SBA EIDL money, be sure to treat it as if it's a debt that you basically are paying for now. So when you prepare a loan application for a lender and they ask you for all the business debts that are currently outstanding, make sure you include that SBA idle loan on that application. Although you might have a deferred payment, I've been seeing a lot of applications coming in without that. So the lender has to go back and say, "Hey, did you get any SBA idle money?" They find out. They'll be doing a search on your business, and the SBA always has a lien on your assets. So be open and disclose that information. Okay, don't be afraid. The lender wants to really know all your debt obligations going in. And right now, the lending environment itself is good. They're open, but they are being more cautious because of the risk that a lot of businesses have taken on as a result of the COVID-19 pandemic. So they're looking at the cash flow, your capacity to repay those loans, and they want to know all the debt that you have so they can include that in their analysis. So just be aware of that. And with that, thank you again, Lori and Lauren, for inviting me to the show. And I look forward to coming back because I know it's probably a lot of questions that people have, but I'd be more than happy to come back.
We actually got a question at the end. We don't have time, and an hour is not long enough. So Lauren, we're going to get Nate back now that we've got him, tied into us. We're going to get him back because I want to continue this conversation. It's so important. So thank you so much, Nate. Lauren, you're going to stay back and take care of different things and go from there. So I am going to click off as well. And to all the audience, thank you so much. Our frequent flyers love having you. And please email Lauren if you want to get in touch with me, the ACT member, or any other SBDC resources. We're out here. We're tax dollars at work. We're here for you. And I look forward to seeing everybody next week where I pull out a blank Excel document and say, don't be more tired and more broke. And this is what you will decide to get there.
All right, guys. Take care.
Bye, everybody.
Thank you, Lori. Thank you, Nate. You guys have a great day. I just wanted to reiterate in the chat, I saw a question about cost. There are no costs for our services. Again, our services with the SBDC are free of charge. If you are in need of some assistance, whether it be for business plans or marketing, access to capital, like what we spoke about today, please just get in contact with us. I will drop my email into the chat right now in case anyone is looking to get in contact with either Lori or Nate. There you go. And then I'm including a YouTube link, and that YouTube link contains all of our past shows. And so today's show will be included later on today. So again, thank you, everyone. Thank you, Annie. Annie is one of our, is my colleague in Pasadena. She's awesome. If you are in that area and looking for some assistance, she is happy to help. So again, shoot us an email and we'll get you guys the help and services that you need. So again, thank you so much. That is it for Small Biz Talk, solutions for your small business. And we will see you again next week, Wednesday at 10 a.m. Thank you. Thank you. Take care.